So let's head straight to Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities, who joins us now to give us his view on the markets. Sanjeev, good morning and thanks a lot for joining in. Greetings of the season to you and your entire team at Kotak. How are you feeling about the market now? I mean, it's been a really strong run that we've seen so far. Do you think these are gains that we can replicate in the next calendar year as well?
Well, I think you're talking about Nifty, right? Obviously, last few weeks have been good for the market in general, given the fact that there is some belief now that the US and global interest rates have peaked and will start coming down sometime, maybe starting from April, May of next year. So that's what has been the big driving force for the Indian market too. But keep in mind the fact that, the last 2 years, the performance of this market is nothing really, great to talk about. The Nifty is up actually only 10% in the last 2 years, up about 8% in the last year or so. So keep that in context, the recent excitement. Having said that, the real excitement is not so much in the large cap, but in the mid cap and small cap names where, the indexes themselves are run up about, 30 to 40% in the last 6 months alone. And some of the stocks, especially in the investment related sectors, have, even doubled in the last 6 months or so. So it's a funny sort of a market in the sense you can actually break it down into three markets in the same market. You have the bear market in large cap, which aren't doing too well. You have a general bull market in the rest of the market, I would say. And then you have probably a bubble market in many of the mid cap and small cap names.
I remember this note that you'd written last week, right, about the three distinct markets: mega caps, bear market, large caps, quality mid caps in a bull market, and mid and small caps are in a bubble market. And Sanjeev, you had flagged off that, I think, what was it called? Mad mid cap rally. This was about a couple of, months back. So tell us the portfolio approach, right, from here on, because despite the exhaustive, extensive run-up that we've seen in mid and small caps, they still continue to attract a lot of retail interest and stocks continue to run up, even if there have been some earnings disappointment. So what's the best way to construct your portfolio from now on? And which would be the mega caps, which are in a bear market, according to you? Which one should buy it and accumulate at current levels?
Yeah, ultimately, as a general principle, you have to look at, stocks more on a bottom-up basis and figure out whether there is any real value in the stocks based on whatever is the gap between the fair value of the company or the stock and the price. And we're just looking at prices and trying to figure out, that this is a good stock to buy or not buy. And that's a foolish pursuit, which unfortunately many people in the market have been doing, just looking at stocks and assuming which are going up and assuming there is value in the stocks. On a portfolio perspective, I think it's better to be the large caps now. The large caps, when I say it's mostly the mega caps, where at least we can see some value in some of them. If you look at the banks, they're pretty reasonably valued. Although, on and off, you keep, getting the negative news in the banks. We had the recent one from RBI where it increased the, risk rates for some of the segments of retail lending. But there is steady value over there on a mid-term basis. Medium-term basis, I assume there is money to be made over there. You could also look at some of the names in, for example, Reliance, telecom sector looks fine. Some of the pharma healthcare names also look fine. So yeah, you can construct a portfolio where you can see some value in some of the names. But broadly speaking, it's not struggle really to find value in this market.
Hi, Mr. Prasad. Good morning. Tell us, going by all that you've said, how have you rejigged your portfolio? I believe on select banking names, you'll have increased weightage, and on some of these chemicals, even specialty chemicals, you'll have, trimmed your exposure out there. Tell us more.
Since you talked about specialty chemical, that's in fact, a good way to approach some of the mid-cap names. I mean, just remember the excitement in the same sector 2 years back. I mean, the stocks were trading at pretty high valuation, much higher stock prices. I look at what has happened to many of the stocks now. So I just hope, the market not setting up itself for some big disappointment in the sectors of stocks that have run up in the last 6 months. On the portfolio part, really, we haven't really changed much. On the margin, we have changed a few things here and there. But as I said, honestly, it's struggled really to find too much of value in the name. So we are sticking with the same stocks, largely the large cap banks, some names in pharma, healthcare services, which I talked about earlier. overweight in consumers, underweight in IT, and Reliance will recover fine. So that's broadly the mix of stocks which we are having. We also have some capital goods stocks and real estate, although I'm just struggling with the way the stocks run up over there.
By the way, the market is still very flat, but the mid-cap end is doing really well. And two spaces, IT and pharma, both doing well this morning. So you have, Divi's Lab, Apollo Hospitals, HCL Tech, that are all the top gainers. And as Sanjeev also said, they are optimistic on the IT space. Sanjeev, I wanted your thoughts on the Tata Tech IPO that opens this week. I know we generally always talk about the secondary markets, but this is a big one, right? It's the first IPO from the Tata Group in 20 years. And there's nothing that looks alarming here. I mean, very strong business, debt-free company. Valuations are looking very appealing compared to its peers. So is this, a subscribe? Is this a story that you like?
Okay, first of all, we are underweight in IT, just to correct that. Again, I can't comment on an IPO which we are not even involved with. Anyway, compliance from that perspective, allow me to talk on IPOs whether we're involved in or not. So sorry, cannot comment on an IPO.
All right, that's fine. But I just wanted your views. Maybe once the stock lists, I can get a better, understanding from you on how that business could grow. But all right, so you said you're underweight on IT. What else? Which are the other themes that you like over the, say, 12 to 18-month period?
I keep going back to the banks only, to be honest with you. We keep going to the big point. There's no value in this market as of now. Barring a few large cap names here and there, we're just struggling to find value. The themes don't really change, right? The themes are all, they're positive on the theme, same thing for God knows how many years and decades now. Whether it is a long-term consumption story of India, whether it is an investment story, which we started talking about 3 years back, outsourcing, etc. Themes don't really change. But having said that, you have to keep the context of valuations over here. And when you marry the themes and the valuations, there isn't really much to look at in this market point in time. But themes are discounted, God knows about, several times looks like to me, especially if you look at some of the investment-related names. We started talking about, a big capex cycle as also the household cycle, which is related to the state. Sometime 3 years back, actually, October, November of 2020. And, we also didn't bargain for the kind of, up move we have seen in some of the stocks over there. Now it looks like, the market has gone into making crazy narratives out of a good structural story. I mean, nobody disputes the structural story of investment in India. But we extrapolate, these things, as if, everything is going to be discounted today. I mean, that is, going a bit too far, I would say.
Sanjeev, I'm reading from your 15th November note. You're saying, we expect the market to finally start taking cognizance of the disruption risk in several consumption subsectors over the next few months as new competitors enter various consumer categories and reveal their competitive strategies. Do you want to elaborate a little bit more on this?
Yeah, so if you look at the consumption-related sectors, whether staples, discretionary durables, etc., what we are seeing is a big change in the operating environment of these sectors, in the sense that, the traditional strengths which these companies had, whether it was the control on distribution, and distribution ultimately in India was largely through the general trade channel, whether it was, very popular brands, etc. What we are seeing is a change across all the traditional strengths of consumer companies. So what is happening, the brands are getting, diluted. Given the fact that, I see more and more, number of brands getting launched, either through the D2C route or whether through the private label route of the retailing companies. Number two, distribution modes are no longer that, valuable as they were earlier, because you are seeing a big change in the distribution mode itself, from general trade to, direct channels, as also modern retailing and so on and so forth. And lastly, even products are also becoming irrelevant. For example, a nice vehicle today, God knows in 5 years' time, what happens to let's say, two-wheelerize once, EVs really take off in a big way. So if you put all this in the context, really there's a lot of disruption coming. The problem seems to the market looking at these sectors and stock the same which I looked at earlier. That is, this company, the sectors will continue to grow at fairly high growth rates, at high profitability for an extended period of time. My view is, fine, the growth will be there for the industry as a whole, but number one, it will split across more number of players, because in every category you're seeing more and more players coming in. And number two, and more important, you're going to see a lot of pressure on profitability. Indian companies' profitability is way too high. That will start coming under pressure as markets start becoming more competitive. And clearly, the stock prices do not factor the risk. As of now, as I was saying, the market is assuming the same set of factors will work for the stocks in the decade of, let's say, the post-pandemic to the post-GFC to the pre-pandemic time frame. The same factors will work in the future, and I don't think so that will be the case. You will see a lot more disruption going forward. And I don't think the valuations factor in the kind of disruption you're going to see across sectors.
So the consumption subsectors where we are seeing very high, competition from potential disruptors. One, you spoke about EVs, right? So two-wheeler auto names, four-wheeler auto names. So that's one consumption subsector. Paint is another industry. Cement is another industry where you are seeing the emergence of large players. Tell us, which of these consumption subsectors?
Every other sector, you look at consumer staples, as private label brands, proliferate, two things will happen. First of all, modern retailing will increase its salience compared to traditional trade channel as it's known. And within modern retailing, what you would also see is the shelf space which is dedicated to private label brand that will also keep on increasing over time, which means you will see more and more visibility of private label brands of Reliance, Reema, or anybody else over a period of time. Which means, the established consumer brands of FMCG companies will probably, not have the same level of dominance in terms of brand and visibility which they have in the shelf place of the Kirana stores currently. So you will see some displacement volumes if it's split across more number of players. You take any sector, you're going to see a lot of disruption, and the market simply is not in the mood to believe there will be any disruption, which I think is just taking a very, very, I guess, simplistic view of how things will change in the future.
All right. Mr. Prasad, you briefly spoke about real estate, but we have a big developer here in Mumbai, Overweight, that's made its foray into the Gurugram, Haryana market. And the street likes it for now. Stock is up more than 3.5% odd. What's your view on the real estate theme? Would you play it via stocks? Would you play it via the ancillaries? Or would you play it via the housing finance companies?
We have been quite positive on this space for some time now. As I said, we've been talking about this since the last 3 years now. And the good thing is real estate cycles are not, short cycles. They're not going to get over in 2-3 years' time. So I suspect this is going to be a more longer-term cycle. Based on the following points. Number one, if you look at the real estate market in India, that was pretty much dead between 2012 all the way till 2021. Between 15 and 21 prices, most of the markets didn't go anywhere. Whether you look at the NCR market, Innova market, Pune, Bangalore, except for Hyderabad, prices have been pretty flat. Which means that in real term, prices are actually down, if you believe up significantly. So the number one factor that, there is a lot of pent-up demand. Number two, affordability is great at this point in time. And number three, prices have just started to move up. Over the last 12 months, 18 months, we are starting to see some price movements in some of the markets. And that is probably the trigger for some of the households which have been sitting on hands, waiting for, prices to move up to start looking at real estate more favorably. And post-pandemic, anyway, I think people want to upgrade housing stock because the quality of housing stock in India is, as we all know, is not that great. And lastly, interest rates in India don't really mean much in the sense, we have only gone back to where we started before the pandemic. If you look at mortgage rates for prime mortgage lending, they used to be 8.5-9% before the pandemic. It went down to about 6.5%. We're back to about 8.5-9% currently. So interest rates really don't have that much impact on demand prices, and the fact that prices trying to move up, that's probably more relevant. So I think this can be a fairly large, long cycle, hopefully sustain 7-8 years or so. And if you compare, let's say, share of residential real estate as a proportion of GDP versus in China, we are nowhere near that. I think we have a long way to go. So that's a long-term story for me. Just
Got it.
Way to play. To play through any of the themes. Only caveat I will have is that some of the building material, construction materials companies' valuations are way too high, and you run the risk of many of the products becoming more what I call standardized over time. Eventually more and more sales in India will be done through large developers. I'm talking about real estate, large developments by large developers, and the traditional strength of the distribution of the building material companies that being, they hold on the distribution channel, which is the retail channel. Eventually, you have to start moving, to direct sales to the builders or developers. And I don't know whether the profitability will be rolled out in that case. It could possibly a lot lower. So there is one risk which you need to keep in mind over here, that the profitability of this building materials / construction companies construction materials companies would start coming down over time.
All right, Sanjeev, we'll let you go on that note. Thanks a lot for joining us. Appreciate your thoughts. Let's